Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton with PassiveInvesting.com. And with us today, we have a special guest, CK Kumar. CK, welcome to the podcast.
Hi, Whitney. Thank you. Thank you for inviting me. A pleasure to be here.
Absolutely. Well, before we dive into the details of the Edgewater portfolio, your 69-unit portfolio in Cleveland, Ohio, talk to us about yourself, like your background and how you got in the multifamily space and where you're at today.
Absolutely. So I'm from a tech background, been in the tech industry last 12 years. I worked for some of the Fortune 500 companies like Apple, Kohl's, and other places. So about 5 years ago, I kind of had a major shift. Basically, I started reading some book on investing, and just as everybody, I read Rich Dad Poor Dad. That kind of had a huge mental shift in my head. Then I got addicted to bigger pockets. So after that, I got really excited and before that, I didn't really know anything about real estate, to be honest, like zero. So started doing some digging, and somewhere around 2017, 2018 is when I started looking into purchasing properties. At the same time, I started running a meetup in San Francisco Bay Area. That's where I used to live. And then I met my current partner, Gaurav, and we both, gelled together very well. And we start picking up some smaller properties and in Cleveland, Ohio. And after that, we soon realized in order for us to scale, we should be purchasing bigger apartments. And that's when we started buying apartments anywhere from 16 unit. So right now, the biggest we have is about 155, 160 unit apartment in Kansas City. So it's been an amazing journey. Basically, we currently operate in 3 different markets: Kansas City, Des Moines, and Cleveland. We are into core Midwest, where there is a lot of stability and decent growth and all that stuff. And we also have our own in-house property management company called One Seed Management. Our company is One Seed Capital, and the property management company is One Seed Management. So we are vertically integrated, and we currently own about 700 plus apartments across these 3 markets.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy-day cash reserve with a high-yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
Awesome. Well, let's dive into the details of the Edgewater portfolio. Again, your 69 units in Cleveland, Ohio. So first, when did you acquire this property and how did you find it? Is it 2 buildings or What is the makeup?
It's a very typical, very different, interesting type of situation where it is a combination of 5 buildings, which are basically located just across each other. The way we found about this is the broker that we work with, we pretty much closed back-to-back 4 to 5 deals with him in the past prior to that. And this one came as an off market where as soon as he got it, he just showed it to us and said, hey, would you guys be interested in this? And the interesting thing is on the same street where this property is located, we own few more buildings. So we kind of understood the demography so well in that neighborhood. We thought, this would be a great deal for us.
Awesome. And when did you close the deal?
We closed it in September of 2022.
Okay. So you already have other buildings in this particular area. What about the market do you like? How did you settle on this market and say, hey, I want to buy 5 more buildings right here?
Absolutely. So we've owned few more buildings that we bought a few years ago, and we understood the tenant base. It's a very upscale neighborhood where a lot of the youngsters want to live. There are a lot of pubs, restaurants, and it's a very upcoming and hot-growing neighborhood, which we've been watching from the last 4 years. And we also understand the tenant base will live there. So that kind of made us, we were very positive, and we were sure on this is a great location that we should be focusing on.
Okay. So the deal comes to you off market. Were you the only person that saw the deal, or did your broker show it to other people as well?
No, it was, as you said, it was an off market. So we got the first right of refusal sort of thing. So we picked it up and we made the decision quite fast that we should go after this one.
Okay. So at what point in time did you decide to go put in an offer on the property? Did you go to the property beforehand, do any sort of due diligence before you put in your offer?
Yeah, we did have a tour, and we have seen. So the interesting thing about that is, out of these 5 buildings, there are 2 retail spaces on the front. So, and one of the retail spaces is a cafe. And it was very funny that we would always go and hang out at that cafe. So we knew about the building. We were interested. We thought, it would be cool if someday, we could buy this building. Somehow it happened. So the moment this deal came across our table, we were sure that, we know this building. We've been to that cafe. We've been to this neighborhood. So yeah, to answer your question, yeah, we did have a tour where we got a tour of all these buildings, just walk around and all that stuff before we could make an offer.
Okay. So you put in your offer. Okay. If you closed in September, when did you put in your offer?
Yeah, it was probably about 3 months before, which is somewhere around May, June timeframe where we made an offer on this property. Yes.
And how did you structure that offer? What were your due diligence timelines? Did you put any earnest money down? Was it hard? Or did it go hard at a particular time? Yeah,
so we did not have any hard money on this one, and ours were pretty comfortable terms. Like we had a 60-day contract period with an option to extend for another month if we needed to. And we had a 30-day due diligence and no money. I think it's about 100,000 where we put in as a EMD on that deal. I think probably 150,000. I think 150,000 we put in as an EMD, and that would go non-refundable after 30 days. Except we had a financing contingency in place. So it was a very tricky situation because of the way the buildings are laid out and a couple of retail spaces on the front. It doesn't perfectly fit into the typical agency financing. So we took some time, but yeah, that's how we structured it. We had a pretty flexible conditions.
Okay, well, I want to get into the details of the financing, but not quite yet. So let's talk about the due diligence. You get your offer accepted. You have 30 days before your earnest money goes hard. First question, did the $150,000, how did you source that? Did you guys have that capital preceded? Did you raise it? Like, how did you, put down that money?
So me and my partners, yes, we came up with that money. We had it. Me and my partners together, we kind of, let's just put the money in and then, go about it.
Okay. So due diligence, offer gets accepted. Walk me through the timeline. Did you go to the property to complete due diligence? Did you walk every single unit? Were there any surprises?
Yeah, no, absolutely. So due diligence, basically, we do 2 types of due diligence. One is a physical due diligence where we actually go to the property, and the other one is a financial audit, financial due diligence. So when we do the physical due diligence, we hire an inspector who basically comes in and looks at all the buildings, and we go to the property. We make sure that we give notice to the seller beforehand so that he can give notice to his tenants a week ahead that, hey, so-and-so date, people are going to be walking through the units and they're going to be looking. So make sure, you're there or whatever. So yeah, we walked through pretty much most of the units, noted down all the issues, basically anything ranging from roof to HVACs, mechanical, boiler systems, and also the condition of the units. So we usually make sure that the inspector does an age analysis and also condition analysis on the mechanicals. We ask him to prepare a matrix so that we understand what kind of capex we need to budget should these things go out. For example, some of the HVACs are like 15, 20 years old, and we know that they may be nearing end of their life, even with the roof and stuff. So so to get an estimate of exactly what type of capex that we could anticipate once we purchase, we did that. And in terms of surprises, not many, because we kind of understand the kind of buildings in Cleveland. Usually most of the buildings that you buy are like usually 1920 construction. That's not typical what people buy in Texas and all other places. People would probably freak out if I say I'm buying a building at 1920s. I have a building that I bought in 1890, so it's pretty good. So we understand that. But those are brick, mortar, and hard buildings, really good if they're taken care of very well. But yes, there are some gotchas. We need to look at plumbing. We need to look at the HVACs. So we make sure of that they're sound.
And did anything pop up on the inspection that was concerning? And where did you come out with your CapEx budget compared to what you were budgeting?
Yeah. So yes, it's basically a typical value add deal where we knew that the market supports a certain amount of rent, and a lot of the units were under rented. And that's one of the reasons was because the seller, it's a mom and pop seller who he and his wife, they own this property for about 20, 25 years. They've really taken care of it as if it's their own, it's their own. So as their own kids. So they've done really good job. But yes, we knew they kept the rents below because they kept the occupancy fairly higher, which is close to 100%, but the rents were very low. So, but we know in order to get there, we need to renovate those units, some of those units. So we kind of planned for that. That was one of the capex. And also we knew that we had some issues with the roof that we found where some of the parapet walls of the roof were a little curved and there were some patches on the roof that could leak and stuff like that. So we had to negotiate back a certain amount and we had to budget for it.
Okay. So you had 30 days to complete your due diligence. Did you retrade because of the roof?
Yeah, we did negotiate about $100,000 worth of renovation. I think we got about $75,000. We asked for 100, we got 75,000 in terms of price reduction on the purchase.
Okay. And how much did you pay for the property?
Yes, we paid about $4.5 million.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFINCon happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFINPodcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
Let's talk about the financing on the deal. What kind of lending did you use? And this is right during the timeline where interest rates are shooting up, and you have a property that's a little bit mostly multifamily, but you do have a couple of storefronts in here. Talk to me about the lending here.
Yes, absolutely. So, typically people buy apartments, they go for agency financing, Fannie, Freddie. We did try that and we knew the interest rates were pretty high on that. But luckily we did talk to some of the local banks, and one of the local banks somewhere in Washington, we found them and they decided to fund us at 4.5%. So that was a pretty sweet deal for us with a 30-year fixed, 30-year amortization, 10-year loan with, even CapEx budget as well. So they are going to be funding the renovation dollars and also the loan, but it's a recourse loan and we were okay with it. So yeah, that's how we went about that.
Interesting. Okay. So recourse loan, 4.5 interest rate, 30-year amortization, 10-year loan. Awesome. Okay. So did you have to put any high amount of reserves and leave them in the bank? Like, how do you do with that?
Yeah, so we gave them a renovation budget. They asked for it. They told they would fund if we plan to do any renovation. So that's what we wanted. We budgeted about $300,000 worth of renovation and we gave them the plan and they approved it. And right now, yeah, it's in escrow and we can draw as we need. They just release the funds to us and we take care of it.
Are there any prepayment penalties on that loan or lockout periods?
Yeah, we have a 5-4-3-2-1 prepayment penalty structure in place. Yes. And there is, I don't know about the lockout period or anything, but yes, at least it's this prepayment. We could pay off anytime, but we need to pay the penalty if we do.
Okay. Yeah. Sometimes banks say, you can't sell the property or refinance the property in the first 12 or 18 months. I didn't know if you were locked out from pulling that type of action. All right. So we were talking before the show, you did raise capital on this deal. So you have $4.5 million. How much did the bank bring? And then how much did you have to raise?
Yep. So the bank funded about 3.2 million-ish, 3.3 million. So we had to bring the rest of the capital. I think I would say about 1.4 million that we had to bring to the table to close the deal. We have a pool of investors that we usually reach out to whenever we raise capital for any deal. So if it is a bigger deal, sometimes we shoot an email to all our investors, we host a webinar and we do typical syndication stuff. But this was a little on the smaller end and we needed 1.4 million. So we did not actually shoot the email to everyone. So we just reached out to some of the investors, some of the friends we know, and our partners itself funded the whole money. Yeah.
Awesome. Okay. And then how did you structure that with your limited partners?
It's a typical JV structure. I mean, it's kind of a syndication, but we did not do a syndication. So we did a JV.
Oh, okay. So 1.4. So how many investors came in on that 1.4 that you raised?
So about 5, I think. So yeah, 5. Some added 200,000. One person did 500,000. I think. And the interesting part I missed was one of the person did a 1031 exchange on this with about 600,000. So that kind of pretty much covered half of it. And we needed another 700,000. So there were another 3-4 folks who put in that money.
Okay. And so the person that did a 1031 exchange did they do a tick into the property?
That's correct.
Okay. And so what kind of returns did you structure for the JV?
Yeah. So the return structures, we don't have any pref return. It's a straight up 70-30 model where 30% goes to the operators versus 70% goes to the people who actually, put in the funds. And yeah, that's it, straight up. No pref returns, nothing else. Simple.
Okay, awesome. Was there any other surprises in due diligence? You mentioned the age of the roof. Did you have any other issues like with insurance, securing insurance because of the age of the roof and the condition of the roof?
Yeah. So the roof were pretty good, but yeah, they had some issues, but not that too severe or anything. But the moment we get the deal, we start shopping around for insurance. We got a pretty good quote. So there was no issue at the insurance. And there were some, let's see. I was just thinking about if there were anything that we found in the financials. But sometimes what happens is that we know the location so well, we know the property so well, we kind of don't go too hard on the financials, go dig everything into the numbers and make sure we know that we can do well on this one. So no big surprises when we bought it. Yeah.
Yeah. Sounded like you're, because of your track record already and on that same street, you were probably a little bit more comfortable with the financials as they were presented. One thing I didn't ask on the partnership structure is, do you have any fees like acquisition fee, asset management fee, capital event fee, and how did you structure those with everybody in the partnership?
Yes. So typically we do 2% acquisition and 2% asset management. And since this is like a JV type of structure, we did not do an acquisition fee, but typically we do 2% acquisition on all our syndicated properties. But we do an asset management fee on this one as across all the properties. And we have our own management company managing it. Yeah. So we were able to kind of plan our budget for management versus payroll and everything because we have our own team taking care of all this.
Well, talk to me a little bit about that, just 60 seconds. With having your own property management company and being a growing company, and you're also managing in 3 different areas, how does that work?
Basically, it started with as a need. We knew when we started third-party management, and that really sucked. And we are very hands-on. We are very much involved every day. So we ask a lot of questions. And the way the property management companies were working, we did not like it. Luckily, we met the right people whom we could hire and build a team. So the current manager we have in Cleveland, she just started with 10 homes. She was managing mom and pop, right? And then we bought her in. We told her, we will give you all the tools and resources and infrastructure you need. Let's build it together. And now she's managing over 200 units comfortably with 2 full-time maintenance staff. Same thing we did it in Kansas City and Des Moines. We met an amazing guy whom we partnered with in creating this management company. And we are doing a massive renovations in Kansas City. And we have a crew of people who does that. So we thought, let's do it in-house. And again, all the skills we had to pick it up in the last few years. Management software, how to use it, how to do accounting, how does all these things work? And sometimes it feels like, do I really need to do all these things? I should just focus on syndication. But the more we do, more we realize that it is so important. That gives us such a huge add-on in being vertically integrated. I think real estate at the end is a people business, right? There's also location and the property itself, but it's a people business. So if you have the right team in place, you could do pretty well.
Awesome. All right. Wrapping up, what did you find easy during this entire closing process that you thought was going to be more challenging? And was there something that was more challenging that you actually thought was going to be easy?
Yep. So the one that I found easy that I thought would be challenging was financing. So when we were under contract, we delayed the closing. I think it took like more than three and a half months. That's just because we were trying to get different quotes from Fannie and Freddie and all that stuff, but somehow the rates and terms didn't work out. So we went with this local bank, and I anticipated once we started with this local bank, there could be a lot of questions, a lot of concerns because there's like multiple buildings involved and they would want to do multiple, inspections and all that stuff. But it went pretty smooth. Very smooth than what we expected. So that was a thing that we thought easy would have been was difficult. I really can't think of anything, to be honest, something that turned out to be difficult in this process. Things were pretty structured. The only thing is, I would say, I think the transition, once we closed, the transitioning of all the data back to our software and getting all the tenants hooked up with everything. And that took a little time, but I think we're good for now.
Awesome. Well, CK, thank you so much for sharing your knowledge and your experience and insights with us here today. If listeners want to reach out to you and follow what you're doing, what's the best way they contact you?
Thank you very much. Absolutely. So yeah, if you want to reach out to me, we have our website, oneseatcap.com, our company, One Seat Capital. The website is oneseatcapital.com. You can go in there and you could go to contact us and just put in your details, or you could email me at ck@oneseatcap.com.
Awesome. Well, CK, again, thank you for your time today and sharing it here with us. We look forward to following you on your future deals.
Thank you very much, Whitney. I appreciate it. Thank you.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.